talk about Chapter 18. Chapter 18 is on valuation, equity valuation models. What does that mean? Well, we're interested in determining the value of common stock. Okay, so let's talk about Chapter 18. Chapter 18 is on valuation, equity valuation models. What does that mean? Well, we're interested in determining the value of common stock. We have different approaches to determining that value, but that's hugely important to us because as an investor, we can identify, we can observe the market price of the stock. Right? That's easy to do. Go online and see what the stock is trading for. But we're trying to decide whether or not it's worth what the market price is. So we want to know the investment value, the intrinsic value of that stock. So there's different approaches, different definitions of value. Your book starts with talking about book value. When you hear the term book value, that's referring to the common equity in the firm. The net worth of the company is shown on the balance sheet. All right? So when you see book value, it's really referring to the equity that's on the balance sheet. If you see book value per share, that's the value of the common equity divided by the number of shares outstanding. So book value rarely would represent really the intrinsic value of the stock. And we really wouldn't expect the market value of the stock to line up directly with the book value, okay? Because the market value is determined in the marketplace. Variety of factors, growth potential, what do investors see about this company? See about the cash flows that they anticipate they will be able to generate, okay? Book value, on the other hand, is an accounting entry. It's the value, assets minus liabilities gives you net worth. And there are a lot of shortcomings or limitations of using book value. So again, I'm not suggesting on any level that when we find the book value, that's what we think the firm should be worth. However, I do think that a ratio that some investors look at is called price to book. What is the price per share relative to the book value per share? And so they look at price to book almost like a multiple. How many times book value are investors willing to pay for the firm's stock? Okay, so price to book is some kind of benchmark, or it's a multiple that may help some investors try to decide how much, whether or not something is where its value is relative to how much equity there is, or the value of the equity in the firm. Your book goes in and justifies, I guess, its rationale for why book value has limitations. And one of those is just how values are entered on the balance sheet. Assets and liabilities, for instance. And remember, assets minus liabilities is going to give us our equity, our net worth. But both assets and liabilities are listed on the balance sheet, not at market values, not at current values, but at historical values. Okay. Additionally, the book value of an asset isn't just its historical value, it also takes into account depreciation, which is an accounting method of allocating the cost of an asset over the life in which it would help generate revenues. So, yeah, there is book value. Book value is an important consideration. Investors are typically interested in how much above book value that current stocks are trading. So it does have some value, but in terms of representing market value, it certainly does not. Another definition of value is liquidation value. If we're trying to establish a floor value, then maybe liquidation is a floor value. That is, the price should never drop below the liquidation value. Liquidation value it represents how much money that we could raise if we broke up the firm, sold all the assets, repaid all the debt, right? Essentially liquidated. You see these, you see advertisements on TV, right, or in the newspaper, going out of business sale, 100% liquidation, right? Well, what they want to do is sell all the assets, take that money, pay off the liabilities, and then what's left is the liquidation value that would be allocated to the shareholders. So one idea is that the stock price should never drop below the liquidation value, because if it did, then some savvy investor with no conscience, I might add, might come in and buy the entire firm, sell all the assets, pay off the liabilities, and still have profit left over. Another measure is called replacement cost. Your book says another measure of the firm is replacement cost less liabilities. Okay. Now, the replacement cost, what would it cost to replace those assets minus the liabilities? So the rationale is that the market value probably cannot stay above this value for very long. Okay? Because if it did, then a lot of competitors would probably enter the market. If it was easy to replace those assets and the market value of the firm was above that point, then it would probably attract a lot of investors, or a lot of competitors would enter the market. And then that competitive pressure that new competition adds would drive down market values until they all arrive then back down at replacement cost. Your book talks about something called Tobin's Q, named after Nobel Prize-winning economist James Tobin, who looks at the ratio of market price to replacement cost. And essentially says that that ratio is going to tend towards 1. It has to. Because if that ratio stays greater than 1 for long periods of time, then that's going to, as we said, it's going to attract competition. And as competition comes in, that drives down value for everyone. It arrives back down to and pushes the ratio back down to 1. All right? Where we're going, though, is we want to develop some concept of intrinsic value. When we talk about intrinsic value, we're talking about present value. What is the present value of the cash flows that this firm is expected to generate going forward? And again, think about the firm, right? You've got, it's not just cash flows, but really cash flows that are going to go to the shareholder. If I'm thinking about buying a shopping center, for instance, I want to know, okay, if we rent that shopping center, if we lease the shopping center out, how much revenue, less expenses is there going to be each month that would go to me, right? I want to know how much is it going to cost me to operate, or rather how much the total inflows are going to be, the outflows to operate the property. I want to know really what is the net operating income that's going to be left over, and then I'll solve for the present value of that. Well, the same on stocks. If I'm thinking about not buying a shopping center, but maybe buying into a company, I want to know, if I make my investment, what am I going to get out of it? What are the profits that are going to come to me? And so that's what we're trying to determine with intrinsic value. Okay? It's the same, it's the present value concept, where this is today, and we expect to receive certain cash flows into the future. So here's a cash flow 1, here's cash flow 2, cash flow 3, all the way out here to, cash flow time period N. And for me to determine what I'm willing to pay for that, I need to know what is the present value of all of those future cash flows. All right? And what we're going to do is we're going to discount these cash flows back at some required rate of return. Your book calls it a capitalization rate. Right? So that's all we're doing, is trying to determine the present value of those cash flows that we expect to receive. So when we think about a company and we're trying to analyze a common stock and determine the value of common stock, we have to think, what are those cash flows going to be? All right? So what we're going to do here is we are going to develop some dividend discount models. Now, our dividend discount models do not work for all companies, right? It's only going to work for companies that pay a dividend. Not all companies do pay consistent dividends. And by the way, it's not just any dividend either. It would have to be a relevant dividend. You know, if a firm has earnings per share of $5 and they're only paying out 15 cents of that earnings in dividends, then my thought is a dividend discount model is really not the best way to go. Because I don't believe for a moment that investors are lining up to buy that 15-cent dividend stream. What we're looking at here, again, in theory, here's D1. That's the dividend that we expect to receive at period 1 if we buy that stock today. D2, D3, all the way through DN, right? Keep in mind that when we buy a stock, there is no expiration, right? A stock doesn't expire. A stock doesn't mature, right? It's a perpetual type asset, right? If you buy shares of Procter & Gamble, your ownership doesn't terminate until you sell your stock. As long as you own the stock, then you're one of the shareholders and you're entitled to your share of the profits as they are distributed. You know, some people have probably owned Procter & Gamble for 50 years. Some people have probably owned General Electric stock for 50, 60 years, or however long they've been in business. Okay? So there's no end in sight. Well, so what we're going to do is we're going to come up with some models, explain some models that can be used to solve for the present value of these dividends. Okay? Now, that's great theoretically. Conceptually, we get it. In the textbooks, it's easy as can be. But here's the problem from a realistic standpoint. We don't know what the dividends are going to be. In fact, I can't tell you today what the dividend is going to be a year from today for any company stock. Oh, I could forecast it. I can speculate. I can look at what the dividend policy has been in the past and make some assumptions. But in terms of being able to accurately and confidently forecast what a dividend is going to be, you know, with no error, I can't do it. And the reason is because you have to understand how the dividend payment process works. Generally, on a quarterly basis, the board of directors for a firm will meet. And this is after the closing of a quarter, right? So at the end of the first quarter, at some point, the board of directors meet, and then they're going to announce what the earnings were for the period. They might announce that the earnings per share for the first quarter ended March 31 was $3 a share. Okay, so the accountants have finished the books. They've closed the books. They said this is what the earnings were for the quarter. And then typically the board will announce dividends. They will say that a dividend per share, if they pay dividends at all, but if they do pay dividends, it'll typically be a function, well, I shouldn't say that, but it's going to be announced generally around the same time that earnings are announced. And they will say that the company has announced that a dividend will be paid of, let's say, $1.50 a share. So I hope you see my point. If the board of directors meets quarterly to determine how much number one, if a dividend is going to be paid, and two, how much that dividend is going to be, then it makes it, think about how difficult it would really be for us sitting here today to forecast not only what the dividend is going to be next quarter, but the next year and the next year and the next year and basically forever. We can't do it. So what we have to do is make some assumptions. I would even call them heroic assumptions. We're going to make some assumptions about the growth or about the dividend stream. So the first assumption that we make, we're going to make the assumption that there's going to be no growth in dividends. Well, if that's the case, let's say, for example, the current dividend that's paid is $2 per share. The required rate of return, which I'm going to try to consistently use the letter K, although for me I usually use R. So I'll try to do K because that's what your book does. But let's say that the required rate of return is 10%. Well, what that looks like for us on a timeline is that if you buy this stock, you anticipate getting a $2 dividend next year, a $2 the next year, because there's no growth. There's no growth in dividends. You expect to receive $2 dividends from now forever. Okay? That's a long time, isn't it? So you expect to receive that forever. Well, how do you solve for the present value of that? How do you solve for the present value of a stream that's going to go forever? Well, it's actually quite simple. What we recognize is that if we were to discount back this cash flow here, that $2 at 10%, that's actually worth about $1.81.8 to us today. That's the present value. The present value of this one is less than that. It's about $1.65. Now, if you're wondering how I'm getting that, you could use your calculator. You could say future value is 2, N is equal to 1, I is equal to 10, because 10% is my interest rate. Solve for PV, and you get 181.18. If you plugged in a 2, you get $1.65. If you plugged in a 3 for the time period, you get $1.50. Okay, so if you'll notice here, if we keep doing this, each future dividend that we're going to receive is worth less and less and less to us. It's going to get to a point that it's almost zero, that it is essentially zero. It's going to approach zero because each one of these future cash flows is worth less and less and less to us presently. Well, if you wanted to, you could plug in, okay, future value is equal to, N is equal to, plug in a large number, 500. I is equal to 10. Solve for PV. I'm going to do it, and then I'm going to show you the real way to do it. 2 is payment. 2 is, I don't know why I just did that. 2, I'm just going to show you what this $2, that 500 periods out, I guess, is worth. $2 is your future value. 500 is in, 10 is I. Solve for PV. You're going to see it's, that's not right. It says it's worth negative. 2 future, 500 and 10 I. Well, that still doesn't make any sense. One more time. I guess maybe my calculator doesn't like that. It doesn't like that. Essentially, anyway, it's about zero. All right. In your calculator, let's forget that. Sure wish I'd have gone through this first. Why don't we do this? We would recognize that this stream of cash flows is an annuity. So why don't we plug in that we're going to receive $2 every year, and maybe let's plug in 500. Let's see if that works. 200 is your $2 is your payment. 500 is in. 10 is I. Solve for PV. And what you're going to get is $20. Actually, you come up and it says negative 20, but that's only because you would have to pay $20 in order to receive that cash flow. The better way to do it, and probably what I should have just done for you smart graduate students, is to remind you that what we've got here is an annuity because it's a series of equal payments that occur consecutively. But it's more than just a regular annuity. It's what we call a perpetuity. It's a perpetual annuity. It goes into perpetuity. It goes forever. And so if you want to know the present value of a perpetuity, it's simply the payment divided by the interest rate. Payment divided by the required rate of return. Here our payment is $2. Our required rate of return is 10%. The answer is $20. So this one's easy, isn't it? If we have a stock that pays a dividend and the dividend is not expected to grow, right? Then we can use this no growth model, and it's just simply payment divided by interest rate, or our dividend divided by the interest rate. Easy. Here's the problem. Okay, I don't think you should make the assumption that there are very many stocks that react that way, that have that characteristic that they don't grow. Okay, maybe that's true, some do, but it certainly doesn't represent most stocks. Let's look at the next model. The next model, we're going to assume that there's constant growth. Again, this isn't the most realistic assumption either, but remember, we have to make some assumptions. We have to make some kind of assumptions about what the dividends are going to look like going forward. So now what we're going to assume is that there's constant growth in dividends. All right. So let's continue with our example. Let's say that the current dividend, I'm going to subscript that 0 to represent it time period 0. The current dividend is $2. Let's assume that our required rate of return still is 10%, that we require 10% on our investments. Let's also assume, though, that we're expecting the dividend to grow at a constant rate of 5%. So now what we have is the current dividend is 2. We've already said that. So next period's dividend is not going to equal 2 because the dividend is growing at a constant rate. So next period's dividend, given this example, if the current dividend is $2 and we're expecting dividends to grow at 5%, then this gives us $2.10 is our expected dividend. Okay? So next period's dividend would be expected to be $2.10. Well, what about D2? D2 will equal D1 times 1 plus the growth rate. So that'd be 210 times 1.05. Let's see what that is. 2.1, 1.05, I think. And I get 2.205. And then we could calculate D3 and D4 and D5. Well, you probably see where this is going. Since there is no termination, there's no expiration, there's no maturity of the stock, we would have to essentially go from now until the end of time. But remember, each one of these future cash flows is worth less and less to us. Now you may say, yeah, but Dr. Durr, their cash flows are growing. That's true. But what we're going to do is make the assumption that our required rate of return is greater than our growth rate. So it is in fact true that our dividends are growing and getting larger, but the discount rate that we're using, the required rate of return, is greater than that growth rate. So it's still, all these cash flows, the present value of all these cash flows is still at some point, the present value of the future cash flows, at some point they're going to converge to 0. That is, even though the dividends are going to be way out there in the future, they're really worth 0 to us present value because they're so far out there. All right? So, what are we going to do? If we make the assumption that dividends are growing at a constant rate, and if we make the assumption that the required rate of return is greater than the growth rate, then the price that we're willing to pay, the present value, sorry I'm messing that up, the price that we're willing to pay for that stock today is equal to next period's dividend, D1, divided by K minus G. This nice formula is actually, it's not an approximation. It actually is the present value today of all of the future dividends that we will ever receive from this stock. It's the present value. If we make these assumptions, 1, it's a dividend-paying stock. 2, the dividends are growing at a constant rate. 3, that the required rate of return is greater than the growth rate. So let's calculate this. D1 is next period's dividend. It's equal to the current dividend times 1 plus the growth rate. So the current dividend we said is $2. The growth rate is 5%. So D1, we've already determined, but we've done it again now, is $2.10. So the price today, we take $2.10 in the numerator. In the denominator, we take our required rate of return. That was given at 10%. Our growth rate is 5%. That's our rate of constant growth. And we get 42. So $42 is the present value of every dividend that we expect to receive from now until forever. This is called the Gordon growth model, also referred to as the constant growth formula, constant growth model. I want to show you something here. So to rewrite this, so the price today, we take D1 over R minus G. So in our example, we had that the current dividend was 2, the growth rate is 5%, and the required return, I'm sorry, see, I already messed up. I called it R instead of K. I'm so used to using R. And our K is equal to, what do we say, 10%. Okay? So now I want to give you a scenario. What if our current dividend is 2? What if our growth rate is 0? And our required rate of return is 10. Does this model work for us? And the answer is, well, of course it does. If we have 0 growth, the next period's dividend is simply going to be whatever the current dividend was. It's just going to be D. And if you've got growth of 0, you've got in the denominator K minus 0, so you're just left with K. So this would be if there was no growth or 0 growth. Guess what? This formula is exactly the same formula that we just had here. Payment divided by K. So if we've got a stock that has 0 growth, the price is simply equal to the dividend over K. That's what we did earlier. I just didn't write it this way. So if there's no growth in dividends, we just simply take the dividend divided by the required rate of return. If there's positive growth, we have to calculate D1, and we divide it by K minus G. I'm just curious, what do you think would happen if there's negative growth? Why don't we do one? Let's say the current dividend is 2. Let's say this stock growth is negative 5%. Our required rate of return is 10%. What's that look like? D1 over K minus G. Let's figure D1. D1 is equal to the current dividend times 1 plus the growth rate 2 times 1 plus negative 5% is the same as 0.95%. I think that's $1.90, isn't it? 0.95, 2 times, so yeah, it's $1.90. So we've got $1.90 in the numerator. In the denominator, we've got our required rate of return minus a negative growth rate. So that's the same as plus that growth rate. I believe we're going to have $1.90 divided by 0.15, which gives me $12.67. So let's take a look at this here real quick. That says $2.10. So we had $42 was 1 when there was growth. When there was no growth, we had 2 over 10%, which is 20. So it makes sense to us intuitively, doesn't it, that we're going to pay more for a stock that has positive growth than one that has no growth, and we'd pay more for one that has no growth than one that has negative growth. The third approach that we're going to use is where and I'm not totally jumping around, but I'm going to get to everything that I want to get to. What if we have multi-stage growth? Multi-stage growth. Okay, so with our multi-stage growth, what we're assuming is that it's not zero growth. Oop, I guess I wrote growth twice, didn't I? Multi-stage growth. Sorry, I was distracted. We're going to make some even more heroic assumptions. But actually, of the three, this one's probably the most relevant in terms of the most practical, in terms of what we're able to, how we might actually use one of these models for determining the intrinsic value of a stock. We're going to assume that, a couple things, but I mean, we can assume that, that growth is not going to be constant, that it allows for variation in growth up to a certain point. That may not make sense, but let me give you an example. All right. Let's say, for instance, the current dividend is $2. And we have looked at an analyst report. And the analyst report have projected that maybe there's going to be some pretty significant growth maybe over the next 3 years. So let's say the growth is going to be 20%. That's huge, isn't it? That's 20%. A firm is not going to be able to sustain 20% growth forever. But maybe they've got a new product, they've got an edge, they've just entered a new environment, something. And so let's say the growth is going to be 20% for 3 years. And then we might expect the growth to fall back down to 5% long term. Let's continue to assume that our required rate of return is 10%. Well, we have two different growth rates here. So there's no way that we can use the constant growth formula today because we don't have constant growth today. In fact, period 1, period 2, period 3, period 4, period 5, we can project what those dividends are going to be. D1 will be the current dividend times 1 plus the growth rate. So that'll be 2 times 1 plus 20%, because 20%, we're projecting 20% growth for 3 years. So that's going to be $2.40. D2 will equal D1 times 1 plus the growth rate. So we'll let that dividend, $2.40, grow at 20%. That gets us to $2.88. D3 will equal the 288, and it's going to grow at 20%. It looks like it's $3, and we'll round it to 46 cents. Okay, but now we see after year 3, growth will be constant at 5%. And so D4 will equal D3 times 1 plus our long-term growth rate. And I get about approximately $3.63. Now, if I wanted to, which I don't, I could solve for D5, I could solve for D6, I could solve for D7, but there's no point because I have constant growth. When I get to year 3, there will be constant growth. I know this is a little silly, but here I am today. There's no constant growth. I've got 20% and then I've got 5%. 1 year from now, I still don't have constant growth, so I can't use the constant growth formula. 1 year later, I still can't because there's going to be 20% growth and then 5% growth. But when I get to year 3, at that point, I can use the constant growth model. I can actually figure out the price at year 3 using the constant growth formula. Remember, let's go look and see what that was. The constant growth formula was right there. If I want to know the price at time period 0, assuming I have constant growth, I use D1, which is the next dividend. It's the dividend that exhibits constant growth, divided by my required rate of return minus the growth rate. So when I get to year 3, if I want to know the price at year 3, I will use the next dividend. The next dividend would be D4 divided by K minus G. So that's what I'm going to do. I'm going to figure out the price at year 3. I'm doing it over here. The price at year 3 equals D4, which is $3.63, divided by my required rate of return, 10%, minus this constant growth. And I get $72.60. So I'm anticipating that the price at year 3, P3, not P4, not P2, not P0, the price at year 3 will be $72.60. If I sell my stock in year 3, I should be able to get $72.60 because it will reflect the present value of every dividend that is expected to grow beyond that point. So I have one thing left to do, and that is to solve for the present value. Now what I'm going to do is say, look, if I buy this stock today, I'm going to receive a $2.40 dividend 1 year from now, a $2.88 dividend 2 years from now. 3 years from now, I'm expecting to receive a $3.46 dividend, and I could sell my stock. My stock is worth $72.60 at that point. So if I combine those together, I've got $76.06 that I expect to receive in year 3 if I buy that stock today. Again, that's assuming I would sell the stock. Even if I didn't sell the stock in year 3, I'm holding a stock that's worth that. You see, this $72.60 represents the present value of D4, D5, D6, D7. So this $72.60 is the present value of every dividend that's going to occur year 4, year 5, and beyond. So when I add those two numbers together, 7606, that's the present value at that point of all those dividends at year 3. But I need to know its value today. So I'm going to discount the $2.40 1 year I'm going to discount the $2.88 for 2 years. I'm going to discount the $76.06 for 3 years at 10%. So you can kind of work it on your own and convince yourself this is $2.18 approximately. Let's do that again. That doesn't look right. 1.1 divided. Nope, that's what it is. Okay. $2.88. Remember, my required rate of return is 10%. That's why I'm discounting at 10%. This gives me $2.38. And then 76.06. I get $57.15 approximately. So I get approximately $61.71. 61.71 is the present value. I'm going to do it one more time real quick just to make sure. 2.8. Yep, $61.71 is the present value of all of the dividends that we ever expect to receive if we buy this stock. And so that, folks, is the intrinsic value. So what we would do would be to compare this $61.71. Let's compare it to the market value. $61.71 is what we believe this stock is worth to us today. Right? We forecasted what we think the dividends are going to be, and we said, okay, the present value of those dividends to us, given some required rate of return, is $61.71. So that's what we would be willing to pay. So now that we have intrinsic value, we can compare the intrinsic value, which is what we calculated. We compare that to the market value. That's what it's selling for in the market. That's the current price. And so if the intrinsic value is greater than the market value, then we want to buy that asset. If the intrinsic value, and by the way, even if it's greater than or equal to, if the intrinsic value, if we really want that stock, we go, well, it's correctly valued. I want that stock. But for sure, I tell you what, I decided to take that away after all. If it's equal to the market value, we say it's correctly valued. If the intrinsic value, though, is greater than the market value, then we think the security must be undervalued. And so we would want to buy it. You'll buy something that's undervalued. If the intrinsic value is less than the market value, then you don't buy. In fact, you might actually sell it. You might either sell it or short sell it, perhaps, because you think it is overvalued. That's where we're going with this. All right. Well, so what we can see then is, again, let's go back and look at the growth here. When we had a no-growth stock, we were willing to pay $2. When we had positive growth, we were willing to pay more. And that makes sense, doesn't it? That makes sense. Well, there's a really interesting exercise, I think, in your textbook that it's kind of an eye-opener, because it shows us that really just to have growth, it doesn't necessarily translate into value. It really kind of depends on what you do with the earnings. Ultimately, our objective as a manager of a firm is to try to maximize stock price, try to maximize shareholder wealth. And, the idea is that as a manager, we're trying to make profits. We're trying to be productive. We're trying to increase wealth for the owners of the company, which would be the shareholders. And so to do that, we need to be productive. We need to invest in productive opportunities. Right? So there's an interesting analysis. I think it starts maybe on page 600 and goes through like 603. But here's essentially what they're showing us. Okay, so what we're going to do now is make some assumptions. Let's say a firm's earnings per share are equal to $5. Now remember what earnings per share. That's just the net income that's left after paying for, you've got all the money that comes in minus the operating expenses, minus taxes, minus preferred stock, minus interest, the earnings that are available to the common shareholder. And if you take those earnings, that's net income really, that's available to the common shareholder, and you divide it by the number of shares, that gives you earnings per share. All right? So let's take a firm that has earnings per share of $5. And the required rate of return on this stock is 12.5%. That's the rate of return really that shareholders require before they will invest in this company. 12.5%. And let's assume, for whatever reason, this firm has a dividend payout ratio. A dividend payout ratio equal to 100%. So what that means is, each period, this particular firm is generating earnings of $5. So if they are paying out 100% of their earnings in the form of dividends, then their dividends are going to equal $5, right? If they made $5 and they pay 100% out to shareholders, then the dividends are $5 per share. So let's assume, okay, there's another formula I want to throw at you that you'll see in this discussion, and it's G equals B times ROE. Well, G is going to be our rate of growth. B is what we call our retention rate. So B represents the percentage of our earnings that the firm is retaining. That is, they're not paying out in the form of dividends. You've heard of that before, retaining or retained earnings, right? So the firm, once they have $5, this particular firm has $5 of earnings, they can either pay it in the form of the dividends to the shareholders, or they can reinvest it back in the firm. It's called the retention. And typically you would think that a firm that retains money is going to grow, all right? So the retention rate basically is 1 minus our dividend payout ratio. So if the firm is paying out 100% in dividends, then it should be clear to you that they are retaining 0. If the firm is paying out 50% in dividends, then they're retaining 50%. If the firm is paying out 40%, then they're retaining 60%. Okay? ROE is the return on equity. So basically the return on their equity investments. So the idea here is that if the firm decides that they aren't going to pay out all of the money in the form of dividends, the idea is they're reinvesting it, and they're reinvesting it in projects that are going to earn this rate of return because they're reinvesting their equity, so the return on equity. So what this G equals B times ROE is, it just helps us estimate the firm's growth. If the firm does in fact retain some of their earnings here, and they reinvest it and earn a rate of return, then I hope you can see that the firm would grow. So what's the growth rate going to be if the firm is paying out 100% in dividends? Well, 1 minus 1 is 0, right? If they're paying out 100% in dividends, they're retaining 0. So 0 times ROE is 0. So the firm is going to have 0 growth. If the firm has zero growth, we've just established that the price of the stock will equal, if there's zero growth, right? It's going to equal, in this case, the earnings per share that they expect next period, which is, again, everything's being paid out in the form of dividends, divided by K. Just to make sure you understand, we wrote a minute ago. I'm going to move it way over here so it doesn't get in the way. D over K was our formula if we had zero growth. So the value of this stock here would be $5 because earnings per share are 5, and they're paying out 100% in the form of dividends. The required rate of return is 12.5. So I believe this gives us 40. Let me confirm that. 5.125 divided gives us a value of $40. Right? All right. Now let's assume that the firm has made an executive decision. Somebody made a decision and said, let's have growth. Let's have growth. And the way we're going to have growth is if we don't pay out 100% in earnings in the form of dividends, and let's reinvest some. So what they decide to do is change their dividend policy. They decide to pay out now 40% in dividends, which means they are going to retain 60%. Okay. Well, since earnings, we've already said earnings are expected to be $5, then now we can say that our dividend next period that we expect to earn, the dividend next period will be equal to 5 times 0.4, which is $2. Right? $2 is the dividend next period. But let's see what impact that has on growth. We said growth is equal to B times ROE, B being the retention rate. So since the firm is paying out 40%, that means they are retaining 60%. And if the firm's ROE continues to be 12.5%, let's go back up here. You remember I had K was 12.5%. So right now, just work with me here. Let's assume that the firm, when they reinvest, they are going to earn the same rate of return that investors require, which is 12.5%. What we're going to see is the growth rate is going to equal 7.5%. 60% of 12.5% is 7.5%. So let's plug it in our formula. Price equals D1 over our required rate of return minus the growth rate. Now, you're probably anticipating, as I would have been, that this stock price is going to be higher. Why wouldn't it be? What we're doing is reinvesting. We're retaining money so that we can grow. We know it says we're going to grow 7.5%. So let's take that. $2 is what we expect the dividend to be next period. Our required rate of return is 12.5%. Our growth rate is 7.5%. And we get a value of $40. Not what I was expecting, perhaps. Not what you were expecting. Why isn't it more? We're retaining money. We're reinvesting it. Well, the reason is, let's come back up here. This required rate of return of 12.5%, that's what investors believe that they can earn on their investments. That's why they require 12.5%. So if our earnings per share are $5 and we pay out 100% to the shareholders in the form of dividends, then they get that $5. And the shareholders are convinced that they can go out and invest that at 12.5%. That's their required rate of return. So if we're giving them $5, they can invest it and earn 12.5. That's why this stock is worth 40 to them. Well, down here, we've decreased what we're going to pay them. But the shareholders are saying, okay, fine. The $2 that you pay me, I can go out and earn 12.5%. But the money, what we've done here, the money that the firm did not pay out in dividends, in fact, retained it and reinvested it, if all they're going to do is reinvest it and earn 12.5%, then there's no net gain to the shareholder. The shareholder doesn't need management to invest for them at 12.5%. They can already invest in 12.5%. So there's no gain. That's why the price doesn't change. Shareholders are not benefiting. Management is earning the same rate that shareholders can earn. So just retention doesn't do anything. Imagine a worse scenario than that. What if the firm says, okay, we're going to lower the dividend and we're going to retain 60% and we're going to put that 60% in a drawer, in a box, in the storeroom? Well, that's certainly not benefiting the shareholders. In fact, the shareholders are worse off in that scenario. So shareholders are only going to benefit whenever management can do more than the shareholder can do. So let's go forward now and let's assume the payout is going to be 40%. The retention is going to be 60% then. Let's assume this the same. Next period's earnings are projected to be $5. Let's also assume that the firm is going to be able to invest and earn 15%. Not 12.5%, but 15%. Let's see what impact that has on growth. Okay? B times ROE. That's going to be 60% times 15, which is 9%. So now we're expecting 9% growth. Let's see what impact that has on the price. Next period's dividend is still going to be $2. And again, that comes from E1 times 0.4. So 5, we're going to pay out 40%, so that's $2. The required rate of return shareholders require is 12.5%. That hasn't changed because that's, how much risk that the shareholders perceive. The growth rate is now 9%. So if we take 2.125, 0.09 minus divided, that doesn't look right. Try it again. 2.125. One more time. $57 and about 14 cents. You see, the value of the firm has changed, hasn't it? The value of the stock has changed. It's not because management decided to retain. It's what they did with the retained earnings. They added value because they can invest in projects that earn a higher rate of return at 15% than the shareholders can earn on their own, investing at 12.5%. Okay? So reinvestment of earnings doesn't necessarily improve anything unless you can reinvest it and earn a rate of return higher than shareholders can get. So your book then, on page 602, they say, okay, then the value of the firm can be thought of as two different things. There is the no growth value plus PVGO, which is the present value of growth opportunities. Earlier when we said, let's just take all of the earnings, if there was 100% dividend payout ratio divided by the required rate of return, that gave us $40. So the value of a stock is at least equal to the no growth value, that is, if the firm paid out 100%, plus the present value of growth opportunities, if there are any. in the first scenario, where management was simply reinvesting at 12.5%, there were no growth opportunities there. But when investors or when managers are able to earn a rate of return higher than the required rate of return, then yes, there's growth opportunities, and the stock price is going to reflect that. So in this particular case, $57.14, when managers invested in projects that are going to earn 15%, the present value of the growth opportunities is $17.14, because that's $17.14 greater than 40, which is what the value of the firm is if there is no growth. Okay. A couple other things here that I wanted to point to that I think will help you understand as you go forward. So let's start here again. We just said that the price equals earnings divided by K plus the present value of growth opportunities. Okay, so this is an equality here. The left side equals the right side. And so if I multiply both sides by 1 over E, or basically divide both sides by 1 over E, oops, didn't mean to do that, so I'll just... What I'm going to end up with on the left-hand side is P over E. This is going to give me 1 over K plus the present value of growth opportunities over E. And then I don't know if it's simplified or not, but I'm going to factor out 1 over K on the right-hand side. This is on page 609 in your textbook. Okay, but one of the things that this shows us, I think, and I'll write it over here, it shows us that the PE ratio increases. Now, the PE ratio is on the left, and I don't know if we've focused a lot on the PE ratio, but the PE ratio is price per share over earnings per share, right? Price per share over earnings per share. And it gives us an indication of how much investors are willing to pay for a dollar of earnings. Let me come over here to the right, upper right, and give you an example. Let's say the price per share is $44, and let's say earnings per share are $4. Then our PE ratio is 11. 44 divided by 4, which is 11. That tells us that investors are willing to pay 11 times earnings. If earnings per share were $5, then we'd say investors are probably willing to pay 11 times 5, which is 55. Typically, growth stocks have higher PE ratios because investors are more optimistic about the firm's ability to generate earnings. Probably the average PE, I haven't checked lately, but I'm guessing the average PE in the market is going to be upwards of 18 or so. 17, 18, 18, 19, somewhere around there. Okay. So that's what the PE ratio. So on the left-hand side, we've got the P of this formula right here. We're seeing that the PE ratio equals this amount on the right-hand side. And what this is showing us is that the PE ratio increases whenever the present value of growth opportunity increases. That's one way we could interpret that, right? Here's the present value of growth opportunity. So as that increases, the PE ratio tends to increase. Another thing it shows us is that if the present value of growth opportunities is equal to 0, then the PE ratio we're going to see is very easy to calculate. It's simply 1 over your required rate of return. Okay, so as the present value of growth opportunities increases, that tells us that investors, as a rule, are generally willing to pay more for the stock, and the PE ratio increases. So whenever investors, holding everything else constant, if stock price goes up, that means investors are willing to pay more for the stock. And so they're willing to pay more for a share of stock if there are present value of growth opportunities. All right. On page 610, I think it is, you'll see this ratio. And again, P, the price, we already know, equals D1 over K minus G. Okay. Well, how do you get the dividend? The dividend is equal to the earnings times 1 minus the retention ratio. 1 minus B, remember B is the retention ratio. So if 1 minus that is the percentage that we're paying in dividends. It's our dividend payout ratio. So our dividend payout ratio times earnings gives us dividends. And in the denominator, we've got K minus G. Well, remember G is equal to ROE times our retention ratio. I'll put some of these over here. Remember, 1 minus B equals our dividend payout ratio. So E1 times 1 minus B equals our dividend. G equals ROE times our retention ratio. All right, now what I'm going to do is, just because it's fun, okay, you may not like this. So let me move a little bit over here. So what we're saying is that our price per share equals that. Now, if I divide both sides by earnings, then what I'm left with on the left-hand side is P over E. And on the right-hand side, my earnings basically that I've got in the numerator there cancels out. And so I've got 1 minus B over K minus ROE times B. And again, these are just reflections, if you will. Okay? This is showing us that the PE ratio, this is an interpretation or an observation, the PE ratio is going to increase with increases in ROE. We can see that. Look right here. If ROE increases, then that's going to make the denominator smaller. As ROE increases, K minus that is going to make the denominator smaller, which would basically increase the ratio. So the PE ratio increases with increases in ROE. That makes sense. If the managers can earn a higher rate of return on the investments that they're making, then that should translate into higher stock prices. Higher PE ratios reflect the fact that investors are optimistic about that firm's ability to continue growing. One more such identity, since I bet you're having fun, on page 612, they give us the PE ratio equals 1 minus B over K minus G. Now, where we get that, let me remind you, if we said the price equals earnings times 1 minus B over K minus G. I know it's sometimes hard to follow, But 1 minus B over here, remember that's our dividend payout ratio, times E is going to give us our dividend. I'll put it down here. E times 1 minus B equals our dividend. So this formula is essentially saying, P equals D1 over K minus G. So that's something we already know. And if I divide both sides by E, then those E's cancel, right? That's going to cancel with that one. And so that's how I get this equation over here to the left, or up here. The PE ratio, right there, equals 1 minus B over K minus G. So what does that tell us? I want you to think back to K. K is the required rate of return. Where do we get the required rate of return on a stock? Well, we get it from the capital asset pricing model that we had talked about in a previous chapter. K is the required rate of return. That's the rate that investors require based upon their risk. Okay? So now let's look at this. This should show us then stocks with greater required rates is reflected by K. Okay, look at this denominator. What's going to happen if K goes up? If the denominator increases, and that's what's going to happen as K goes up. The denominator is increasing, it makes that whole relationship decrease. So stocks with greater required rates of return are going to have lower PE ratios. Right here. If K increases, that means the denominator is increasing, which lowers, as the denominator increases, the ratio gets smaller. So that means the PE ratio would be less. Stocks with greater risk, that's what K is representing. Stocks with greater required rates of return, so i.e. greater risk, are going to have lower PE ratio. And it makes sense because higher required rates of return lowers present value. You're not willing to pay as much for an asset that has more risk. Holding everything else constant, it lowers what you're willing to pay for that stock. Okay. There are some other types of benchmarks in addition to like PE ratio. Your book talks about some other comparative ratios. PE is a comparative ratio, right? We're comparing price per share over earnings per share. Investors look at PE ratios. They also look at price to book, which we mentioned at the outset. So this is on page 616. We might look at price to cash flow. We might look at price to sales. These are all just benchmarks. These are multipliers. Price to earnings, price to book, price to sales, price to cash flow. And one might be more appropriate than another given the type of company. For instance, maybe you've got a company that really hasn't had positive earnings yet. It's an upstart company, but it still has market value. Investors are buying this stock like crazy. Okay? It's certainly not because they have good earnings. It's because they have the potential down the road. But they still need, if a firm has zero earnings or negative earnings, then the PE ratio makes no sense. So we might have to look at price to cash flow. Maybe the firm has negative cash flow, so that doesn't make sense. We might have to look at sales, price to sales. So the issue here is that there are different valuation multiples and it depends upon the type of company, or it depends upon the cash flows that they're generating, whether they're positive, negative, or zero. All right, that's going to do it here for, I'm not going to go into free cash flow, by the way. So as you are studying this particular chapter, the last couple of pages get to free cash flow valuation approaches. I just don't think they give us enough information at this age, or at this stage, to work on free cash flow. So I'm going to pass on that. So that's going to conclude my contribution, my lecture, my explanation of the material in Chapter 18.